What I plan to do now is just take you through the highlights of our first trading period as a listed company, and then John Phillips, who's here with me, will take you through some of the financials, and then I'll come back for a little bit of a wrap-up at the end of that. So if we start out on slide 2. So in a tight market, our first half pro forma results are very pleasing. They're in line with our forecasts contained within prospectus, and they're in line with all of the subsequent guidance that we've given. Revenue was up 19% on the PCP. EBITDA was up 12% on PCP, and NPAT was up 7% on the PCP. So strong numbers. In relation to our revenue increase, the most substantial contribution to that was our network operations revenue. That's up 31% on PCP, and in addition to maintaining our network margins at guidance levels. And I'll talk more about that shortly. But in relation to the construction revenue, we're particularly pleased with a 4% revenue increase here, particularly given that that has been generally a challenging housing market in the past period. One of the things we did was we continued to pursue our volume-based discount model, which we disclosed in the prospectus, along with our indicated appetite to increase our exposure into that mid to high-end MDU apartment market. So we did both of those initiatives, and both of those have met their forecast results. First half construction includes a higher component of MDU and commercial projects, which has produced, although they produced a lower construction margin. The second half forecast sees a more traditional mix for us of SDUs and MDUs, and we'll see the resultant improvement in construction margins as a result. Our operating expenditures are in line with prospectus guidance as well. Looking at slide 3, our contracted pipeline, that now exceeds more than 140,000 lots, and that provides around about 7 years of work at today's construction rates. In addition, we have 26,000 lots in progress, which is up 21% on the PCP, and I think that indicates a growing market share. And that's in a growing market share in what the developers are currently calling a pretty tough, slow half for them. Meanwhile, we continue to win new business at rates 28% up on PCP, and that continues to add to our contracted pipeline. And as I said, I think it indicates a very strong growing market share. Constructed lots remain in line with PCP, albeit with some mix change over the PCP. So I'll now look at slide 4. We continue to add new active customers, and the first half has seen a net 6,300 premises added. That's 12% up on PCP. ARPU continues to grow as well, and we're just over $51 in December. That's up 8% on the PCP, and it continues to grow in line with global forecasts of growing data usage and the move to faster speed plans. Remember, our ARPU is driven by 2 parts, a fixed and a variable. This data growth is driven primarily from video, and we're seeing that as increasingly being offered as your TVs are coming as 4K HD now, and 8K HD TVs formats are now available in the marketplace as well. So total connections are now at 86,000, and the ratio of connected to completed lots has improved over the PCP. Move to slide 5. Our business is really a recurring revenue-based business, and every month we add additional active customers, and their usage, driven by that higher data usage and higher speed plans, continue to increase. So that continues to drive our ARPU higher almost every month. The rate of connections continues to be stable and in line with our forecasts, despite what has been a tight half year. As I said earlier, we are prepared to offer small discounts in exchange for volume and whole of business signings, and that was in line with our forecasts. And our first half included a higher ratio of lower revenue MDU construction than in previous halves as we increased that market share. So we went chasing some of that market, we're successful in it, but there is a slight reduction in lower revenues for those. Despite this, total construction revenue increased, but it fell as a proportion of total revenue, and that will remain so because as the connected customer number grows, the result in ARPU increases and network wholesale revenue increases accordingly. I think I'll hand over to John now to take you through some of the financials.
So I'm on slide 6, just a bit more detail on the numbers. So as Paul's already highlighted, our overall revenue was up 19% on the PCP, which is a really strong growth rate. The prospectus rate of growth was about 16%, so that's well up on the guidance in the prospectus, and that's really been underpinned by the growth in network wholesale revenue, which is up 31%, driven by net add of 6,300 active users, which is well up on the PCP, and the move of those new users into higher speed plans. So we now have nearly 60% of our user base on 50 or higher meg plans. At the same time last year, that was 46%. So that's driving the increase in ARPU, which you've seen. It's now sitting at about $51, and the increase on the PCP is about 8% at a spot rate of December 18 to December 19. We do expect ARPU to continue to increase, but there will be some price changes coming through in the next short period of time, which will closely match our price levels to the new NBN price levels. We don't expect the headline ARPU to change, but we expect that the growth that we've got of 8% on a rolling 12-month period probably to come back a little bit, but we still expect to get growth on ARPU. On construction revenue, I think Paul's talked about that at length. Really pleasing result to get that revenue line up 4%. We do see over time the construction revenue line under some pressure, particularly in the MDU space where there's a lot of operators there that are going to zero very quickly. We are targeting the mid to high end sector of that market, so there is still revenue there in that sector, and we are gaining market share, and that's a result of the services and solutions that we're building in our commercial business that can translate into that apartment and broadacre space. So the MDU component of the construction profile in the half was around 20%, which was higher than the PCP, and also probably slightly lower sell rates. The ICN business, which is the commercial and integrated network solutions, that contributed or doubled its revenue in the period from $1.5 to nearly $3 million. So that was a really good outcome, but that is at a lower margin than our traditional broadacre business. But once again, very happy with construction revenue going up in what is a difficult environment. On the earnings, the margins that we get on our network operating revenue are consistent with what we guided the market to in the prospectus. We are continuing to invest in the network, as Paul has indicated. We're building capability to deliver 1 gig services everywhere. There is some cost associated with that, but we still expect our margins on the network to remain within the forecast levels that we've previously provided. In the half, the construction margin was lower, and we've outlined why that was with the mix change and also improvement in the integrated communication network part of the business, but we expect that margins will improve in construction in the second half. On the balance sheet, obviously cash is very strong. IPO proceeds are in that number. I'll talk about cash flow in a sec. Network infrastructure continues to expand, and that comprises both lots in progress and completed. So there's a cocktail in that increase from 60 million to 80 million. But that network expansion and investment, most of which is funded externally, will drive ongoing increases in our network wholesale revenue. So as our network expands, growth asset, growth network, new actives get connected and then become recurring. So we want to see that network infrastructure continue to increase. Next slide, cash flow. We had operating cash flow for the half of 15.8. The prior year was 13. That's at a stat level. On a normalised basis, there's some one-offs that we had in the half. So we had a tax instalment that we paid in FY20 that should have been levied to us in FY19, but the tax office levied us at a lower rate than what we should have got. So there's $1 million catch-up payment there, so that needs to be added back in. And we had about $1.8 million of one-off CapEx, corporate CapEx in the half, which both of these items we called out in the prospectus, so it's just reiterating that. The corporate CapEx relates to three components: replacement of our core network from old technology to new technology, replacement of our network operating systems, and fit out of our new office in Port Melbourne. Those three investments are all one-off, sort of one in every 10 to 15 year investment. They added to about 1.8, plus the tax of 1.1, rounded out to $3 million. So effectively our normalised free cash flow for the half was 6, and the PCP was under 4. So a good result on cash flow.
Okay, I'm looking at slide 8 now. And as we've said before, despite a challenging housing market, our construction revenues have continued to grow. All indicators for an improving market, with increased demand as the consumer credit becomes more available. And also the first home buyer schemes at both the federal and the state level are further driving demand. Regarding the MDU market, we actually look at that market as two distinct markets. And it's split between the low end, which is the primarily investor-targeted markets, and they subsequently have higher percentage of short-term renters, Airbnb and low-income buyers. We've got very little interest in participating in those developments, as they typically have low take-up rates, and they usually take the lower speed plans, and therefore they generate lower returns. Our market focus has been on the developments and the developers that target the owner-occupier or the downsizer, typically that older demographic that wants all the bells and whistles of their current home, but they want to have a inner CBD lifestyle. And we've been pretty successful in that sector. In the half just completed, we added over 9,000 lots contracted in that sector, primarily in that middle to high-end market. The other area that we've done particularly well in is we've established ourselves in the independent living unit market, and we've contracted over 6,000 lots in this sector, and we expect to close many more before the end of the financial year. Now that sector is a growing sector, and it covers not only the assisted living and the retirement villages, but it also covers the rapidly growing lifestyle villages, where younger couples are moving from their suburban homes after their children leave home, and they go into these cost-effective, luxurious villages. You know, they have all of the facilities and things for them, where they don't have to worry about home maintenance and garden upkeep and things like that. So they're looking at it as a lifestyle change, and that's a growing market. And the nice thing about them is that they will typically enter these estates and take high-speed, big bandwidth plans from us. So they're extremely profitable as well. Our Integrated Solutions Group also continues to win support from the commercial sector, and that's where our turnkey solutions are proving to be very valued. Not only do we do the telco network, but we do all of the assisted building management and security and telephony needs for the commercial sector. And the experience that we gain in that integrated network sector, which is much more complex, that really sets us up really well for what we're seeing in our domestic area, where we see smart city and IoT integration becoming more a common feature within these community housing estates. If we turn now to slide 9, the demand from the consumer for fixed line broadband continues to grow. The latest ABS data states that data demand grew 28.1% between June 2017 and June 2018. And 96.8% of that demand was provided over fixed line broadband. So demand continues, and it's going to continue to be on fixed lines. The part that's driving most of that demand and growth in data is primarily video, and we're seeing everyone is realising now that a typical family of four probably needs at least 50 megabits per second to be able to drive 2-3 TV sets, high-speed internet, online gaming, and all the activities that we now consider as normal in a home, without it feeling clunky and freezing up on you. In fact, 4K TVs require between 15 and 25 megabits each, and the new 8K TVs need somewhere between 20 and 50 megabits each. So you've got a couple of TVs in your house, you're rapidly going over that 50 megabit demand, and you'll start to see lock up on that. So we see more and more drive as these TVs head into the domestic market, higher speed plans, increased ARPUs. I mentioned smart city developments earlier, and that's another growth market for OptiComm. Housing estates continue to evolve into communities in their own right, and they're looking to become more self-sufficient and more control of their development and facilities. In fact, local governments and their planning departments are now releasing and demanding more services and facilities to be provided as part of the development approval. So before a developer can develop his land, he has to be able to say how he's going to be able to provide smart city type applications into it. From our experience in the commercial sector, we've got a host of services we can offer them. We get them across that hurdle for them. We will, as John said, continue to invest in improving our network capacity and redundancy. I think many of you would have seen some of our plans at the recent Investor Day. And we're now planning, as John said, to offer the capability to all of our RSPs to provide 1 gig services across our whole network. We see that becoming a requirement, and it's a challenge for many of our competitors. The other thing as we grow is we continue to become more attractive to the RSPs. Pretty soon the brownfield NBN build-out will be finished, and that race that they've had for market share, they'll shift their attention from the brownfield and start thinking about growing in the greenfield. We're perfectly positioned to pick up more RSPs. More RSPs mean we're more attractive to developers. At the last update, we indicated that the federal government was planning to reintroduce into Parliament a telecommunications reform package, which includes the regional broadband scheme, which is more commonly known, I guess, as the Bush tax. That's now occurred, and it's waiting final debate in the Senate. So the tax, if it's passed, as we expect it will be, that's going to impose about a $7.10 monthly charge on OptiComm for every active premise over a threshold of 55,000. So therefore, our forecasts and our guidance have assumed the introduction of this tax, and everything we're talking about is taking that into account. Overall, we're extremely satisfied with our first half year as a public company. We continue to grow our contracted pipeline, we expand our network infrastructure, and we organically grow our network wholesale revenue. So in summary, the outlook is supportive of the forecasts outlined in our prospectus.